we get your guidance as well that you're talking about. I think we have to cut across to the RBI governor who is addressing the press. Let's hear him out.
Transmission of monetary policy to the real economy depends very crucially on a smooth functioning of the financial markets as well as financial intermediaries like banks and NBFCs. It is in this context that the key and complementary functions of the central bank, such as setting of interest rates, liquidity management, regulation and supervision over the banking and other segments of the financial sector, they have become even more pronounced. These functions work together to support economic growth by maintaining financial stability and promoting responsible behavior among financial institutions. Let me now specifically turn to the concept of resilience, which is the theme of today's conference. Systemic resilience depends both on the resilience of individual financial institutions as well as on the interdependencies among them. A resilient, future-ready bank needs to be financially, operationally, and organizationally resilient. To be financially resilient, a bank should have adequate capital buffers and be ready to generate earnings even in times of severe macroeconomic shocks. It should also have adequate liquidity to meet its obligations in various situations. Therefore, financial resilience is closely linked to a bank's business model and strategy. The Reserve Bank has therefore started looking at the business models of banks more closely. Aspects or deficiencies in the business model itself can spark a crisis in due course. We have not only prescribed regulatory norms for capital adequacy and liquidity ratios, but even gone beyond to nudge the banks to build up capital buffers in good times and times of plenty. As you may recall, we did this during the COVID-19 pandemic times when there was plenty of liquidity in the system, when the interest rates were low, and when the full impact of the pandemic on the financial sector was still highly uncertain. Now, talking about the business model, I think the recent developments in United States in particular, there is again questions about whether the business model of individual banks that have faced challenges, that have faced difficulties, whether their business models were right. There are questions being asked all around, but I am not going into that. Because these business models sometimes can sort of create risks in certain parts of the balance sheet of a bank, which going forward can blow up into a bigger crisis. So therefore, we are focusing now on the business models adopted by the banks, and I will touch upon it a little later in more detail. The Reserve Bank has put in place various prudential regulatory frameworks. These include, as is well known, capital adequacy requirements, asset classification, provisioning requirements, even dividend distribution and liquidity management framework, etc. In addition, the Reserve Bank also periodically deploys macroprudential measures to address system-level buildup of risks. As a consequence of the measures taken by the Reserve Bank, and the banks themselves, I must mention here, the Indian banking system has remained resilient and has not been affected adversely by the recent sparks of financial instability seen in some advanced economies. This also comes out clearly in our recent stress test results. The gross NPA ratio, that is the gross non-performing asset ratio for the scheduled commercial banks in India, was 4.41% at the end of December 2022, down from 5.8% on March 31st, 2022, and 7.3% as on March 31st, 2021. The CRAR at 16.1% at the end of December 22 is also much above the minimum regulatory requirement. Macro stress tests for credit risk indicate that scheduled commercial banks would be able to comply with the minimum capital requirements even under severe stress situations. Nevertheless, recent events in the banking landscape of the United States and Europe suggest that risks for an individual bank could crop up from segments of its balance sheet which might have been considered relatively safer. Hence, we expect the management and board of directors of each bank to continually assess the financial risks and focus on building up adequate capital and liquidity buffers even beyond the minimum regulatory requirements. And this is required for continued resilience and sustainable growth of individual banks and financial entities. Now, turning to operational resilience, let me say that operational resilience would mean that a bank should be able to deliver critical services even in face of disruptions. Cyber risks and possible cyber attacks are on top of the list so far as such disruptions are concerned. Cyber risk has been identified as the foremost in top 10 operational risks for 2023 based on a global survey of financial institutions. The Bank for International Settlements, that is BIS, while revising the principles for sound management of operational risks in 2021, introduced specific principle on information and communications technology, that is ITC risk management, reflecting the importance of this risk. Robust IT and information security governance would help in increased predictability and reduction of uncertainty in operations, minimize losses from information security related incidents, and enhance operational resilience. Given the extensive level of outsourcing being done by the banks and by other financial entities, there is even greater need for ensuring that effective policies and practices are put in place in this regard. Even the G20 finance ministers and central bank governors are focusing on risks arising from third-party dependencies. The Reserve Bank has taken a slew of measures in recent years with usage of advanced analytical and surveillance tools, along with techniques like phishing simulation and cyber reconnaissance exercises to push for enhanced IT and cyber security governance processes in banks as well as in other supervised entities. In the context of growing exposure of our regulated entities to various risks from dependencies on third parties which provide technology and IT-enabled services, the Reserve Bank has recently, that is on 10th April this year, just about 20 days ago, the Reserve Bank has on 10th April issued comprehensive guidelines on information technology outsourcing by banks, NBFCs, and other regulated entities. Now, the third component of resilience, I mentioned about financial resilience, organizational resilience. The third component of resilience for banks and others is to, I think I mentioned about financial resilience, operational resilience, and the third component is organizational resilience. So let me now focus on organizational resilience in brief. Banks and other financial institutions also need to be organizationally resilient so that they anticipate risks early and absorb them efficiently. Organizations must have the capacity and resilience to protect themselves from adverse incidents and shield their balance sheets. To achieve organizational resilience, regulated entities need to continuously evolve by standardizing policies, processes, organizational culture, and governance. They must also be flexible enough to encourage diverse ideas and innovations within the organization. You see, there is one thing, the institution by itself should have the inherent organizational resilience to withstand crisis. And I elaborate upon it a little more as I elaborated, I will, delve in greater detail on this as we go forward. Now, let me just also in this context touch upon the pillars of Reserve Bank's regulatory and supervisory strategy. An important element of our strategy of making the Indian financial system, including the banking system, future ready is the robust and enhanced regulatory and supervisory framework which we have put in place. Our present approach to regulation and supervision has been built essentially on 3 pillars. First, one of our focus areas in recent years has been to strengthen governance and assurance functions within the regulated entities.
All right, that's the RBI governor speaking at the Financial Resilience Conference. Quite an apt theme, perhaps, given the times that we live in. And he's actually alluded to some of that, saying that it is really important for central bankers to keep watching financial markets very carefully, because financial market stability is extremely important to ensure monetary transmission. He of course observes that whatever's going on in the West is not at all what we are seeing here in India. Talks about the strength and the resilience of the Indian banking sector. He also goes on to say that banks in India should look at perhaps generating profits even in tougher times, and that the Reserve Bank of India has started looking at business models of banks very, very carefully, because he says that in the US, it is the business models that have been flawed. That's what the recent crisis, if I could call it that, that has thrown up, or what has come to light, looking at the Western economy issues with respect to banks. So that's the Reserve Bank of India laying out the roadmap in terms of financial stability in the capital markets, also being a fairly important point for central banks. So we'll take a quick break on that note. We'll come back on the other side and kickstart all the action on Trading Hour.